Here's a dirty little secret in the mortgage industry. 95% of loan officers don't know how to analyze tax returns. But stay tuned, you've got options with or without them. It's critical when buying or refinancing your home that it is done properly, because when they can qualify you based on your tax returns, you get the best terms and conditions. At the same time, one of the big advantages of being self-employed is taking advantage of the tax laws as they are written. Think about it. Some of the wealthiest people in the world are self-employed, and they've certainly had advantages and influence on how the tax laws are written. Moreover, CPAs are tasked with minimizing your tax burden to the lowest possible number. However, as I once heard a senior level mortgage banker share this, he said that we've got the IRS, which is a government agency, and then we've got Fannie Mae, which is kind of a quasi-governmental entity now. And Fannie Mae sets the guidelines that most lenders in the United States adhere to. So what he was saying was, you've got two institutions, you got the IRS and then you got Fannie Mae, and they're not going to allow a self-employed person to reduce their tax liability to the lowest number possible and then give them a different number when they go to borrow money. So basically he's saying you can't have your cake and eat it too. It's going to be one or the other. Now, with all that said, it's not uncommon that we see self-employed people not getting approved for the loan they submitted their application for. But fear not, there are options for self-employed people when your tax returns do not show sufficient income. We do have some other great options. So what does that mean to you as a self-employed person? It means that you do not have to show tax returns, and we can still do an income analysis and qualify you for a mortgage. So how does it work? Well, we collect 12 to 24 months of bank statements, either your personal or business. And then what we do is we take a look at all the deposits, we add those up and divide them by either 12 or 24 months. 12 months is the most common, but if we need to show the income a little more stable, we will go out to 24 months. Then an expense factor ratio is applied. It can be as little as 15% all the way up to 50%. It was really dependent on your type of business, whether you have a certain amount of employees or contractors versus a sole proprietor. Or another way is if you have a tax preparer, CPA, that prepares your taxes, and if they are willing to put in writing what your expense factor ratio is, say maybe 30%, then we can use 70% of the deposits to analyze as your income. For example, we had a client who was looking to purchase a $1.4 million property. After we looked at the tax returns and did our analysis, unfortunately, they didn't qualify based on what we would call a full doc loan. However, we were able to take their last 12 months of bank statements, analyze the income, and we had over $100,000 in income per month that we could use to qualify them. They were able to purchase their home easily and live in it comfortably now. Another avenue is a P&L. So if you have a tax preparer, CPA, that is willing to do the last 12 months P&L, we can look at that as well. Credit score requirements are as low as 640. You can put as little as 10% down on these programs. However, really to get the most and the sharpest rates on the programs, typically you need at least 20% down payment. We need to verify the existence of your business for at least 1 year. Two of the most common ways of verifying that is either a letter from your CPA or a business license. There are refinance options where you can do a cash out if you'd like to maybe pay off some debt or invest in your company. And then really after that, after we've analyzed your income, it's really like any other loan in regards to we look at debt to income ratio, credit scores, and what we would call cash to close, which consists of your down payment and closing costs. So to recap, it is really important when you're looking for mortgage financing that you work with a loan officer and a company that understands and knows how to analyze tax returns properly. Now, once that's been determined, if you do not qualify for enough of a loan amount or home that you desire, then a bank statement or a P&L loan are a great alternative. I would not suggest that somebody stop looking for a home or get into home ownership just because they could not be qualified based on their tax returns. These are great alternatives. We have a lot of people that are in homes now that they would not otherwise be in without these programs. Whether you're ready to start house hunting or would just like to chat about the home buying process, my team and I are here to help. We are licensed in over 40 states and would welcome having a free consultation to see what's possible for you and your family. If you liked the information that I was just sharing, if you would do me a huge favor and hit the like button, share if you know somebody that could also use this information, and subscribe for more home buying tips. Thanks again.